All right, so today we're going to take a deep dive into the mind of Warren Buffett. You sent over some awesome material on his investing strategies, and I'm excited to unpack some of these golden nuggets with you.
Yeah, it's interesting with Buffett. It's not just about like to picking stocks. It's really about cultivating a whole different way of thinking about investments.
Yeah.
He's really playing the long game, and that's a key part of what sets him apart.
Okay, so let's start with that long game. One of the most famous Buffett quotes is, "Our favorite holding period is forever." But is that really realistic? I mean, for the average investor, I mean, forever is a long time.
Yeah, and that's why understand that the why behind that statement is so crucial.
Hmm.
Holding on to a stock forever isn't the goal in itself. It's about finding businesses that are so fundamentally strong, with such a durable competitive advantage.
Right.
That you'd be comfortable owning them for decades. He's not looking for a quick flip.
Yeah.
He's looking for companies that are built to last.
Right, so it's more than just picking a company that's doing well right now. It's about looking at their long-term potential, their ability to weather economic storms and adapt to change in markets. That makes sense, but it also requires a ton of patience.
Exactly. And,
Yeah.
and that patience is what helped him avoid getting swept up
Mm.
in speculative bubbles like the dot-com craze. While everyone else was chasing, the next hot tech stock, Buffett stuck to his guns, focusing on undervalued companies with proven track records. That discipline to stay the course is a hallmark of his approach.
Speaking of discipline, I've heard that Buffett spends the majority of his day reading. Is he just catching up on the latest financial news, or is there something more to it?
It goes far beyond just reading headlines. He dives deep into financial reports, analyzes balance sheets, pores over income statements. He once said that accountant is the language of business, and he's fluent in that language.
Okay, so it's not just about reading for pleasure. It's about gain a deep understanding of how businesses operate, their financial health, and their long-term prospects. But let's be honest, most people find those financial statements pretty intimidating. Is that something that the average investor really needs to master?
Well, you don't need to become a CPA overnight,
Yeah.
but understanding the basics can give you a huge advantage. Take the debt-to-equity ratio, for example. Buffett uses this to assess a company's financial leverage, how much debt they're using to finance their operations. A high debt-to-equity ratio can be a red flag, indicating potential vulnerability during economic downturns.
So by learning to decipher these key metrics, we can start to evaluate a company's financial stability and make more informed decisions. It's about doing our own due diligence, just like Buffett does.
Precisely. And that brings us to another crucial aspect of his approach: staying within your circle of competence. This isn't just about being smart. It's about knowing what you don't know and avoid investments that fall outside your area of expertise.
But doesn't that limit your opportunities? I mean, shouldn't you be open to exploring new industries and emerging trends?
There's a difference between being open-minded and venturing into territory where you lack the knowledge to make sound judgments. Take Buffett's aversion to investing in airlines for many years. He saw it as a notoriously volatile industry with unpredictable profits. Only when he saw a shift in the industry structure, with fewer major players and more potential for sustainable profits, did he finally invest.
So it's not about being stubborn or closed off to new ideas. It's about being honest with yourself about your limitations and sticking to areas where you have a genuine understanding. That takes discipline, especially when everyone else seems to be jumping on the latest bandwagon.
And that discipline ties into another key Buffett principle: ignoring market noise. He doesn't get caught up in the day-to-day fluctuations of the stock market. Instead, he focuses on the intrinsic value of a business, its long-term earning potential, and its ability to generate cash flow.
So it's about seeing beyond the ticker symbol and understanding the underlying business, its strength, its weaknesses, and its potential for future growth. That makes sense. But how do you actually determine that intrinsic value? Is it just a gut feeling, or is there a more structured approach?
While intuition plays a role, Buffett relies on rigorous analysis. He dissects financial statements, evaluates management teams, and considers a company's competitive landscape. He's looking for businesses with a wide moat, meaning a strong competitive advantage that makes it difficult for rivals to erode their market share.
I've heard that analogy before, but can you give me an example? What does a wide moat look like in the real world?
Think about a company like Costco. Their membership model creates a loyal customer base. Their bulk buying power gives them a cost advantage, and their reputation for quality and value further strengthens their position. That's a multi-layered moat that makes it very difficult for competitors to challenge their dominance.
Okay, so it's about identifying those unique factors that give a company an edge, something that sets them apart from the crowd, and allows them to maintain profitability over the long haul. But aren't those advantages constantly being challenged? I mean, new competitors emerge, technologies disrupt industries, consumer preferences shift. How can you be sure that a company's moat is truly wide and sustainable?
That's where the real work comes in. You need to delve deep, analyze industry trends, and assess a company's ability to adapt and innovate. It's not about finding companies that are immune to change, but those that are best positioned to navigate those changes and emerge even stronger.
It's about looking for companies that are not just successful today, but adaptable enough to be successful tomorrow. So it's not just about identifying a wide moat. It's about evaluating its depth and its resilience over time. That's fascinating. And I think this is a perfect place to pause and gather our thoughts.
Indeed, we've laid a solid foundation here. Exploring the key elements of the Buffett mindset. Long-term thinking discipline, a focus on fundamentals, and the importance of understanding competitive advantage. In the next part, we'll delve into how these principles translate into real-world investment decisions and examine some of his most successful bets. Welcome back to our deep dive into the world of Warren Buffett. In part one, we explored his unique investment philosophy, focusing on long-term thinking, in-depth research, and the importance of a wide moat. Now let's see how these principles translate into actual investment decisions.
Yeah, I'm ready to see how this all plays out in the real world. I know Buffett's portfolio is incredibly diverse, but are there any common threads that kind of run through his investments?
One of the most consistent themes you'll find is his preference for businesses that provide essential products or services. These are companies that people rely on regardless of economic conditions. Think about his investments in companies like Coca-Cola, Geico Insurance, and even Kraft Heinz.
Oh, okay. I see where you're going with this. People might cut back on luxury items during tough times, but they're still going to buy groceries, insurance, and yeah, even ketchup.
Exactly. These businesses might not be the flashiest or the fastest growing, but they offer a level of stability and predictability that appeal to Buffett's risk-averse approach. They're the anchors in his portfolio, providing a steady stream of earnings and dividends.
Speaking of Coca-Cola, that's probably one of his most famous and successful investments. What did he see in that company back in 1988 that made it such a compelling opportunity?
At that time, Coca-Cola was already a global brand with a dominant market share, but it was facing some headwinds. There were concerns about competition from Pepsi, health concerns related to sugary drinks, and some questioned whether they could maintain their growth trajectory. But Buffett saw something different. He recognized the enduring power of their brand, their unparalleled distribution network, and the potential for continued growth, especially in emerging markets.
So it wasn't just about the fizzy drink itself, it was about the strength of their brand, their global reach, and their ability to generate consistent profits. And I'm guessing that wide moat played a significant role in his decision.
Absolutely. Their brand recognition, their secret formula, and their bottling and distribution network created a formidable barrier to entry for competitors. That's a classic example of a durable competitive advantage that Buffett looks for.
It's fascinating to see how he was able to kind of see beyond those short-term challenges and recognize the long-term potential of the business. But let's be honest, not all of his investments have been home runs. He's had his share of missteps and miscalculations along the way, hasn't he?
Of course, even the greatest investors make mistakes, and Buffett is the first to admit that. He's often quoted as saying, rule number one, never lose money. Rule number two, never forget rule number one. But it's not just about avoiding losses. It's about learning from them. He's known for his ability to analyze his mistakes, understand what went wrong, and adapt his strategies accordingly.
Yeah, that's a crucial point. It's not about being perfect. It's about being a continuous learner, being able to adapt and evolve as the market changes. Speaking of adaptation, one of Buffett's more recent investments that kind of surprised a lot of people was his stake in Apple. He'd famously avoided tech companies for years, but then he made this huge bet on Apple. What shifted his thinking?
It's a perfect example of his willingness to adapt while staying true to his core principles. For years, he'd steered clear of tech companies because he felt he didn't fully understand the industry dynamics. But with Apple, he saw something different.
So what was it about Apple that convinced him to change his stance? Was it their sleek design, their innovative products?
While those factors played a role, it was much more than that. He recognized the incredible loyalty of their customer base.
Yeah.
People weren't just buying iPhones, they were buying into an ecosystem, a lifestyle. And that translated into a level of recurring revenue and pricing power that was incredibly appealing.
So it was that recurring revenue, that ability to generate consistent profits that aligned with his investment philosophy. It wasn't about chasing the latest tech trend. It was about finding a company that met his criteria for long-term value creation.
Exactly. And let's not forget, Apple had also become a cash-generating machine. They had a massive war chest of cash on hand and were returning value to shareholders through dividends and buybacks. That's music to Buffett's ears.
Okay, so we've seen how Buffett applies his principles to consumer goods giants like Coca-Cola and tech titans like Apple, but his portfolio is so much more diverse than that. He's invested in railroads, energy companies, banks, and even a furniture retailer. How does he approach such a wide range of industries?
It all comes back to his focus on understanding the underlying economics of a business. He's not just looking at the industry trends or the latest headlines. He's digging deep into the financial statements, analyzing their costs, their margins, and their return on capital.
So it's not about being an expert in every industry. It's about having the framework and the analytical skills to evaluate any business regardless of its sector. It's about understanding the fundamentals of how a company makes money and creates value for its shareholders.
Precisely, and that's why he often compares investing to baseball. He says you don't have to swing at every pitch. You could wait for the perfect opportunity, the one that's right in your sweet spot. And that patience, that selectivity, is a hallmark of his approach.
That's such a great analogy. It's about waiting for those pitches that you can hit out of the park, the opportunities where the potential upside far outweighs the downside risk. But it's not just about finding those opportunities. It's about having the discipline to act on them, right?
Absolutely. One of his most famous quotes is, "Be fearful when others are greedy, and greedy when others are fearful." It's about having the courage to go against the herd, to buy when others are selling, and to sell when others are buying. That contrarian approach is a key part of his success.
But that takes a lot of mental fortitude. It's easy to get caught up in the emotions of the market, to let fear and greed kind of dictate your decisions. How does Buffett manage to stay so calm and rational when everyone else is panicking?
It all comes back to that long-term perspective we talked about earlier. He's not focused on the day-to-day fluctuations of the market. He's looking at the big picture, the underlying value of the businesses he owns.
So it's about zooming out, seeing beyond that short-term noise, and focusing on the long-term fundamentals. That makes sense. But it's easier said than done. What are some practical tips for cultivating that long-term mindset?
One helpful exercise is to imagine you're buying a piece of a business, not just a stock ticker. Ask yourself, would I be comfortable owning this company for the next 10, 20, or even 30 years? If the answer is yes, then you're on the right track.
That's a great tip. It forces you to think beyond the short-term hype and focus on the long-term viability of the business.
Exactly. And remember, Buffett himself has said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. That's a powerful statement about the importance of patience and long-term commitment.
Okay, so we've talked about his preference for essential businesses, his ability to identify companies with a wide moat, his focus on understanding the economics of a business, and his contrarian approach to investment. But there's another aspect of his strategy that I'm curious about, his approach to risk management.
Ah, yes. Risk management is a crucial part of any successful investment strategy, and Buffett has some unique insights in this area.
Well, we've already touched on diversification, but what other strategies does he use to kind of mitigate risk?
One of his most famous principles is the margin of safety, which we discussed earlier. It's about buying investments at a price significantly below their intrinsic value, creating the cushion that protects against potential setbacks.
Right, so it's like having a built-in buffer, a margin for error in case things don't go exactly as planned. But how does he actually calculate that margin of safety? Is it a gut feeling, or is there a more structured approach?
While it's not an exact science, there are certain metrics and qualitative factors that he looks for companies with a strong track record of earnings, consistent cash flow, and a conservative balance sheet. He also takes into account the quality of management, the competitive landscape, and the overall economic environment.
So it's a combination of quantitative analysis and qualitative judgment. It's about assessing both the financial strength of the company and its ability to navigate future challenges.
Exactly. And the wider the margin of safety, the lower the risk. It's like buying $1 for 50 cents. Even if your initial assessment of the company's value is slightly off, you still have a cushion to protect you from significant losses.
That makes sense. But finding those opportunities where the price is significantly below the intrinsic value, that takes a lot of research and patience, doesn't it?
Absolutely. It's not about chasing the latest hot stock or trying to time the market. It's about being patient, disciplined, and waiting for those rare moments when a great company is available at a bargain price.
It's like being a value shopper, always on the lookout for those hidden gems, those undervalued treasures that everyone else has overlooked.
Exactly. And that's what makes Buffett such a fascinating investor. He's not just crunching numbers. He's thinking critically, he's asking questions, and he's willing to go against the grain if that's what his analysis dictates.
It's about having the courage to be different, to think independently, and to trust your own judgment, even when it goes against conventional wisdom.
Precisely. And that brings us to another important aspect of risk management, emotional control. The market can be incredibly volatile, and it's easy to get caught up in the emotional roller coaster of fear and greed.
Oh, I know that feeling all too well. You know, when the market is soaring, I feel like a genius, and when it crashes, I just want to hide under a rock. But Buffett seems to have this almost superhuman ability to stay detached, to make decisions based on logic, not emotion.
It's not superhuman, but it definitely takes discipline and a certain mindset. He's famously said that the stock market is a manic depressive, and he's learned to avoid getting swept up in its mood swings.
So it's about recognizing that the market is inherently emotional, but your investment decision shouldn't be. It's about having a plan, sticking to it, and not letting fear or greed kind of dictate your actions.
Exactly. And one way to cultivate that emotional detachment is to focus on what you can control, your analysis, your investment process. Don't worry about what the market is doing today. Right. Focus on building a portfolio of high-quality businesses that you understand and believe in.
That's a powerful reminder. It's about shifting your focus from the external noise to the internal factors that you can actually influence. It's about being proactive, not reactive.
Precisely. And that proactive approach extends to another key aspect of Buffett's philosophy, his focus on cash flow. He's not just looking at a company's earnings. He's analyzing their ability to generate cash, which is the lifeblood of any business.
Okay, so cash flow is king, but why is it so important to Buffett? How does he use it to make investment decisions?
He views cash flow as a more reliable indicator of a company's true profitability than net income, which can be manipulated by accountant tricks. He's looking for companies that generate consistent and growing cash flow, as this gives them the flexibility to reinvest in their business, pay dividends, buy back stock, or make strategic acquisitions.
So it's about finding companies that are not just profitable on paper, but actually generate real cash that can be used to create value for shareholders. It's about looking beyond the accountant gimmicks and focusing on the real drivers of business success.
Exactly. And that focus on cash flow is a key part of his approach to value investing. He's looking for companies that are undervalued by the market companies whose stock price doesn't fully reflect their true earning potential.
That makes sense, but how does he actually identify those undervalued companies? Is there a secret formula?
There's no magic formula, but there are certain metrics and qualitative factors that he looks for. He pays close attention to a company's price-to-earnings ratio, its price-to-book ratio, and its free cash flow yield. He also analyzes their management team, their competitive landscape, and their long-term growth prospects.
So it's a combination of quantitative analysis and qualitative judgment. It's about looking at the numbers, but also understanding the story behind the numbers, the factors that drive a company's success.
Precisely. And he's not afraid to go against the grain, to invest in companies that are out of favor with the market, as long as he believes their intrinsic value is significantly higher than their current stock price.
It's about having the courage to be different, to think independently, and to trust your own research, even when it contradicts the prevailing market sentiment that's incredibly inspiring.
It is, and it reminds us that successful investing is not about following the crowd. It's about doing your own homework, forming your own conclusions, and having the conviction to stick to your principles.
Okay, we've covered a lot of ground in this part, from his investment philosophy to his risk management strategies, and we're starting to see how these principles translate into real-world investment decisions. But there's one more area I want to touch on before we move on, his approach to selling.
Yes, selling is an essential part of any investment strategy, but it's often overlooked. Many investors get so focused on buying that they forget about when and why to sell.
Exactly. So how does Buffett approach selling? Is he constantly buying and selling, or does he tend to hold on to his investments for the long haul?
Remember his famous quote, "Our favorite holding period is forever." He's definitely a long-term investor, but he's also pragmatic. He recognizes that there are times when it makes sense to sell, even if you love the company.
Okay, so what are some of those scenarios where he might consider selling a stock?
There are a few key triggers. One is if the company's fundamentals deteriorate, if their earnings start to decline, their competitive position weakens, or their management team makes poor decisions. Another trigger is if the stock price becomes significantly overvalued, exceeding his estimate of its intrinsic worth.
So it's not about emotional attachment. It's about making rational decisions based on the current situation and the long-term prospects of the business.
Exactly. He's willing to part ways with the stock if the original reasons for buying it no longer hold true, even if it means taking a profit or accepting a loss. But he's also incredibly patient. He's not afraid to hold on to winning investments for decades as long as the business continues to perform well and the stock price remains reasonably valued.
That's a tough one for a lot of investors, myself included. It's tempting to take profits when a stock is doing well, especially if you've seen a significant gain.
I understand it's human nature to want to lock in gains, especially when the market is volatile. But Buffett's approach reminds us that sometimes the best move is to do nothing to stay the course and let those winning investments compound over time.
It's about resisting those emotional urges and sticking to your long-term strategy.
Precisely. And that brings us to another important aspect of the Buffett mindset discipline. It's about having a plan and sticking to it, even when the market throws you curveballs. It's about avoiding those knee-jerk reactions that can lead to costly mistakes.
So it's not just about being smart, it's about being emotionally intelligent, right?
Absolutely. Successful investors requires a blend of intellectual and emotional discipline. It's about being able to control your impulses, stay focused on your goals, and make rational decisions, even when the market is going crazy. And even with all his discipline and careful planning, Buffett also recognizes the importance of adaptability.
So it's not about being rigid, it's about being flexible enough to adjust as the world changes.
Precisely. Think about how much the world has changed since Buffett started investing in electricity. We've seen technological revolutions, economic upheavals, geopolitical shifts, and yet he's managed to adapt, to evolve his thinking and his strategies to stay ahead of the curve.
That's a great point. It's about being open to new ideas, being willing to challenge your assumptions and adapt in your approach as the market evolves. It's not about clinging to outdated strategies or refusing to acknowledge changing realities.
Exactly. And that adaptability is a key part of what makes him such a remarkable investor. He's constantly learning, he's always seeking new information, and he's not afraid to adjust his course when the situation demands it.
That's truly inspiring. It's a reminder that even the greatest investors are constantly learning and evolving, that there's always something new to discover, and that the key to long-term success is to stay curious, adaptable, and open to new possibilities.
Couldn't have said it better myself.
Why, I think this is a perfect place to pause and gather our thoughts. We've explored Warren Buffett's investment philosophy, his risk management strategies, his approach to selling, and even his philanthropic mindset in our final part. We'll distill some key takeaways and actionable insights that you can apply to your own investment journey. All right, welcome back to the deep dive. Over the past two parts, we've been on quite a journey exploring the world of Warren Buffett, from his investment philosophy to his remarkable success and even his philanthropic endeavors.
Yeah, it's been incredible, really seeing what makes him such a unique and insightful investor. Now, as we wrap up our deep dive, I'm curious, what insights have really resonated most with you?
Well, one of the most striking takeaways for me is the importance of shifting from a short term to a long-term perspective. Buffett's famous quote, "Our favorite holding period is forever," really highlights that commitment to enduring value.
Yeah, it's not about trying to time the market or chasing quick profits.
Yeah.
It's about finding businesses that are so fundamentally sound, so well-positioned for the future, that you'd be content to own them for decades.
Right, but how can the average investor realistically adopt that mindset? I mean, forever seems like a daunting time frame, especially in today's fast-paced world.
Yeah, that's where the concept of circle of competence comes in. It's about recognizing your areas of expertise and focusing your investments on industries and businesses that you truly understand. Now, this doesn't mean ignoring new trends or emergent sectors altogether. It means approaching them with caution, doing your due diligence, and only investing when you feel confident in your understanding.
So it's about acknowledging your limitations and staying within those boundaries where your knowledge gives you an edge. But wouldn't that limit your potential returns? I mean, some of the biggest gains come from those early investments in disruptive technologies or emerging markets.
That's true. But remember, Buffett's approach is all about minimizing risk. He'd rather miss out on a potential windfall than invest in something he doesn't fully grasp. And his track record speaks for itself.
Right. It's about balancing potential reward with calculated risk, but finding those forever companies, the ones with the enduring competitive advantages. That's got to be the real challenge, right?
Absolutely. It requires more than just looking at current performance. It's about analyzing a company's moat. Those factors that give them a sustainable edge over competitors. This could be a powerful brand, a unique technology, a cost advantage, or even a network effect that makes it difficult for rivals to catch up.
Okay, so it's about digging deeper, understand it in the sources of a company's strength, and assessing whether those advantages are likely to endure over time. But how can you predict the future? I mean, industries are constantly evolving, new competitors emerge, and consumer preferences shift. How can you be sure that a company's moat won't be eroded by these forces?
Well, you can't predict the future with certainty, but you can look for companies that are adaptable, innovative, and constantly evolving to stay ahead of the curve. Think about how Amazon has continuously reinvented itself, expanding from an online bookstore to a global e-commerce giant, a cloud computing powerhouse, and even a grocery delivery service.
Right. It's about finding companies that are not just riding a current wave, but those that are building the surfboard for the next one. They're not just reacted to change, they're shaping it.
Exactly. And that brings us back to the importance of continuous learning. Buffett is a voracious reader, constantly absorbing information and seeking to expand his understanding of the world. He doesn't assume he knows everything. He's always curious, always questioning, and always looking for new insights.
So it's not about becoming an expert in every industry. It's about cultivating that thirst for knowledge, that intellectual curiosity that drives you to learn and grow as an investor.
Precisely. And that learning should extend beyond just reading financial reports and industry analyses. It's about understanding the broader economic landscape, the geopolitical forces at play, and even the psychological factors that influence market behavior.
Okay, so it's about being a well-rounded investor, someone who is not just financially literate, but also aware of the wider world and the forces that shape it. But even with all that knowledge and insight, there's still an element of risk involved in investing. So what are some key takeaways from Buffett's approach to managing risk?
Well, we've already discussed the importance of diversification. Spreading your investments across different asset classes, industries, and geographic regions is a fundamental principle of risk management. But it's not just about spreading your bets, it's about choosing those bets wisely. And that's where Buffett's famous margin of safety principle comes into play.
Okay, remind me what margin of safety means in this context.
It's about buying investments at a price that is significantly lower than their intrinsic value. This creates a cushion, a buffer, that protects you from downside risk, even if your initial assessment of the company's worth turns out to be overly optimistic.
So it's about finding those bargains, those undervalued gems, where the potential upside outweighs the downside risk. But that requires a lot of patience and discipline, doesn't it?
Absolutely. It's about resisting the temptation to chase the latest hot stock or jump on the bandwagon when everyone else is buying. It's about waiting for those rare moments when a great company is available at a discount, when fear and panic have driven the price down below its true worth.
Yeah, it's like being a contrarian shopper, waiting for that end-of-season clearance sale to snag those designer items at a fraction of their original price.
Exactly. And that brings us to another crucial aspect of risk management, emotional control. The market is driven by emotions, by fear and greed. And those emotions can lead to irrational decisions. Buffett is famously disciplined. He doesn't get swept up at the hype or the panic. He sticks to his principles, focuses on the fundamentals, and makes decisions based on logic, not emotion.
So it's about recognizing that the market is a roller coaster. But you don't have to ride every twist and turn. You can choose to stay grounded, focus on the long term, and make decisions that are aligned with your goals and your risk tolerance.
Precisely. And one way to cultivate that emotional detachment is to view your investments as part ownership in real businesses, not just ticker symbols on a screen. Ask yourself, would I be comfortable owning this entire company? If the answer is yes, then you're on the right track.
That's a great mental shift. It forces you to think beyond the short-term price fluctuations and focus on the long-term value creation potential of the business.
Exactly. And it helps to remember that Buffett himself has said, the stock market is a device for transferring money from the impatient to the patient.
So it's about playing the long game, being patient, being disciplined, and focusing on those fundamentals that drive long-term value.
Absolutely. And finally, as we wrap up our exploration of the Buffett approach, I think it's important to touch on his philanthropic mindset. He's not just focused on building wealth for himself. He's committed to using that wealth to make a positive impact on the world.
Yeah, that's such an inspiring aspect of his legacy. It's a reminder that financial success isn't just about accumulating wealth. It's about using that wealth to make a difference, to contribute to a better world.
Exactly. And he's shown us that it's possible to align your financial goals with your philanthropic goals, to invest in companies that are making a positive impact, and to use your resources to support causes that you believe in.
Yeah, it's a powerful message and one that I think resonates deeply with many investors today. We're not just looking for financial returns, we're seeking investments that align with our values, that contribute to a more sustainable and equitable future.
Absolutely. And that's perhaps the most enduring legacy of Warren Buffett, the idea that investment can be a force for good in the world.
Well, I think we've covered an incredible amount of ground in this deep dive. We've explored the key principles of Buffett's investment philosophy, his approach to risk management, and even his philanthropic vision. I'm walking away with a renewed sense of inspiration
Mhm.
and a deeper understanding of what it means to be a truly successful investor.
It's been a pleasure exploring these insights with you. And remember, the journey of investing is a lifelong pursuit. Stay curious, stay disciplined, and never stop learning.
And on that note, we'll wrap up our deep dive into the world of Warren Buffett. Thanks for joining us.
Until next time, happy investing.